In finance, short selling, or just shorting, is betting that something will fall in price. It could be a currency, a futures contract, shares, or another asset that can be traded quickly. So how does shorting work? Imagine you are an investor and you think shares of the Rask Group are overpriced. You decide to short it. Here's how you do it. You find a big investment firm or broker who has 100 shares of the Rask Group. These shares are priced at $1 each. What's important to remember is the number of shares is 100. You say to the broker, "I would like to borrow your shares." The broker says, "Okay, but I want them returned in 3 months with 5% in interest." You agree to the deal and take the 100 shares. Then, you sell them on the share market for $100. That is, for $1 each. In the next couple of months, bad news surfaces about the Rask Group's CEO, and the shares fall from $1 to 20 cents each. Using the $100 you had from the earlier sale, you buy back the 100 shares. This time, however, you can buy 100 shares for just $20 or 20 cents each. You can now take your 100 shares back to the broker or investment firm as you had agreed. They're now worth $20, but that doesn't matter to them. The agreement was for 100 shares, which you borrowed. You also owe the broker $5 in interest. That's 5% of $100. So how does the investor make money? Let's focus on the cash flow for the investor. It didn't cost the investor anything to enter the contract up front, but he sold the shares for $100, so that's $100 in his pocket. Then, he had to buy back the shares for $20 and pay the broker $5 in interest. That's cash outflow of $25. So what the investor is left with is a $75 profit. How about the broker? You might not think it, but the broker also wins from the deal, because if they didn't enter the contract, which cost them nothing to do, they would be sitting on losses of $80 because the shares are now priced at 20 cents each. But thanks to the 5% in interest, some of the risk was avoided. For brokers and large pension funds, conservatively lending shares to be shorted by investors can be a simple way to make a few extra percent in interest. For investors, short selling can be very risky because losses are unlimited. For example, if the share price rises. Nonetheless, shorting can be profitable if you pick the investment's timing and direction correctly. What's more, legitimate short sellers play a vital role in ensuring investment markets and CEOs are doing their job correctly.